Good morning, everybody. Happy Thursday. So, today I am going to do our live from the vacation mode. So, I apologize for the for a little bit delay by one day. And here is David joining us. So, we're going to be doing the live from the travel mode, but anyways, there are a lot of mortgage questions that we get to answer with David Kazarian from IQ Mortgage. Here is David. We're just waiting for David to join us. Good morning, Gordon. Good to see you.
Good morning.
Hi, David. How are you?
I'm all right.
Good morning.
What's going on?
Just doing this little live from the vacation mode, and we do have Gordon here who joined us. And actually, last time Gordon asked us a couple of questions from the last sessions about the 2-1 buy downs.
Good.
So, and I think that we owe him to respond it right away while he is on a live with us. So,
okay.
Let's talk about 2-1 buy downs, 3-1 buy downs. What is the question was to talk and to break down the 2-1 buy down and how is it different from the regular buy down. And Gordon is here, so he's going to correct me if I'm asking his question wrong. But I'm going to pull it out. So could you tell us a little bit about 2-1 buy downs and why would, as a customer, I take the 2-1 buy down versus the permanent buy down? What is the difference?
Okay. All right. So,
Gordon gives me the thumbs up, so I worded it out correctly.
Okay. Of course. So here's how this works, Gordon and everybody else that's watching us. We have what's called the par rate. Par is when you call a loan officer, we look at your information, here's the rate that you qualify for. You don't pay anything for that rate. That's what's called par. We always have the option of doing permanent buy down. Permanent would be for the 30-year loan term. So if rates today, March 16th, are 7.5 for a conventional loan, then you could pay a certain sum to go down to 7.25, 6.75. That would be the permanent for the duration of that loan, right? So that's permanent. It's a bit more expensive. We the industry came up with what's called a temporary buy down, which means it's 2-1 or 3-1, meaning, what does that mean? Means in the first year, in the case of 3-1, in the first year, the rate drops by 3%. In the second year, the rate drops by 2%. And in the third year, the rate drops by 1%. So 3-2-1, basically, that's what it is, 3-2-1 buy down. So if you were to do the 3-2-1 buy down, your rate today would be 4.5 for the first year, this year.
For the first 12 months. For the first 12 payments are going to be way lower. Correct.
Of course. Yeah, much, much lower. And the second year would be 2% lower than today's rate. We always orient with today's rate. So it would be 2% lower, would be 5.5. And in the third year would be 1% lower, which would be 6.5. In the fourth year, it does go back to 7.5% and all the way to the end of the term, which is the 30-year term.
Excellent. Now, the question that is very important for the buyers. What happens is within, like we know that rates are fluctuating. So what happens if, let's say, a year from now, rates are, rates go low, and they're at 5%, and you already paid, and do you have to wait for 3 years? When can you refinance?
You can refinance anytime. It's a wonderful question. If we're still on the subject of the temporary buy downs, which is the 2-1, 3-1. So here's how this works. Let me sort of explain the rest of it for, I don't know if Gordon's still here, but to explain the rest of it. So if we're doing a 3-1 or 2-1 buy down, basically what's happening is we're taking money a lot of times from the seller. So this temporary buy down is financed by the seller, and whatever
you cannot you cannot finance it as the buyer, correct?
You
it
can.
has to come. Can you?
In the beginning, you couldn't. Now you can. You can, by all means, pay for it yourself. What happens is, it's important to understand that your loan does not change. This is the biggest misconception that I want people to know. Your loan does not change. We're still originating a 7.5% loan for 30 years. What happens is, once your loan is originated and closed, we know of the escrow account. We know of the kitty account, which holds money for insurance, taxes, right? And mortgage insurance a lot of times. So we have this escrow account that we make deposits into every month. So what happens is, now we took a certain sum from the seller, we deposited into that account, and it's there. It's your money, and the bank, the servicer of your loan, is going to take a certain sum and apply it to your mortgage. Thus, your payment becomes 3% lower. Technically, you're welcome, Gordon. Technically, what happens is, we take that savings of 3%, whatever the dollar sum would be to save in 3%, and we apply it to your mortgage payment every month. And so you have an X amount of dollars sitting in your kitty account. Good question, Alexandra. What happens if rates drop? What happens is that whatever's there and you haven't used it up gets applied to your principal. Your principal is reduced. Beautiful. So it's not wasted.
Excellent. Thank you, Gordon. Any questions that you have, you can always watch us in a recording, and thank you for your questions. So, did I hear it correctly that from the day this program actually appeared till now, it actually changed? So now the buyer can pay for this program.
Correct. The buyer can pay for it. Yes, and the seller can pay for it. So it is allowed. It's not back in August, it was 2-to-1. It was only restricted to being paid by the seller. It is not restricted anymore.
Can it still be combined with other offers or with other buy downs?
It can be. You can do a permanent buy down and a temporary buy down together. Let's say the seller's giving you so much money you don't know what to do with. We could do a permanent buy down, and on top we'd do a temporary buy down as well. Yes.
Excellent. Is it available for all the types of mortgages? Is it available for conventional FHA and VA, or only for conventional?
No, conventional and govies.
Excellent. So that was the question from the audience from last time that we didn't answer, but today I specifically wanted to talk to you about about financing new construction. And the reason why is that because we're dealing in Las Vegas market in particular with a very low inventory. And whether we want it or not, we are shopping a lot with the new home builders. And it becomes tricky because our poor customers, they don't get they don't get enough time to adjust to the changes of the market. And everything moves so fast for them that they're like, oh my God, I just learned this process and now you're taking me to the new home builder and now it's the brand new process, and they're like, now all the things and the rules change. So can you please tell us if your company or if other lenders are capable of financing new home construction?
Absolutely. We can finance new construction. That's one thing that the builder may give you a certain incentive, a certain amount, and to entice you to work with their lender, in-house lender, and they will not give you the incentive, and then obviously you're going to work with them, and then we step out. As soon as we hear of that we're not going to be involved because there's another lender involved. But yes, we could do new construction loans, and especially if you and I have a client going right now that there is a loan program that the builder isn't able to do,
not work with. Yes.
Then we're gonna step in and finance that client. Yes.
And I can say from the realtor's point of view, so builders, they do offer us incentives, but those incentives are usually only good for only few types of loans. So there could be like A, B, and C, like 1 out of 3.
Right.
And if your file is something different, if you're going through a different loan program, so for example, most of the new builders are going to finance FHA, conventional, and VA. Some of them would go like only 3 loans, and only if your profile is perfect.
Yes.
If you've been switching from W-2 to 1099, or you switch jobs or something, like there is something a little bit more complicated in your profile, most of the builders are going to say, no, you guys are way too complicated. We don't want to work with you. And guys, if you heard it from the builder, if you got denied by the builder's lender, it doesn't mean that you need to quit. Exactly. You need to go and get a second opinion. Go and get a second opinion, but don't go to the bank, like big name bank, because you're probably going to hear the same thing. You need to go to a mortgage broker like IQ Mortgage. Why? Because they work with, David, how many different programs you guys work with?
Oh, God. At some point last year, we had 69 different programs. We reduced it down to, it was really not necessary. Just alt programs themselves, I would say we have close to 7 different alternative programs, which most lenders have 1 if they do. And that covers the whole industry, honestly. If I need to go get more, I will, but we could just about do anything that's licensed in Nevada.
That means that no matter how complicated the file is, if it is financeable, you guys are going to work through with the client, and you're going to show them the way how they can finance the property. And it doesn't really matter whether it's a new construction, if it's a resale, or even if it is a commercial property. Am I correct?
Okay, commercial property is a bit different. I do have outlets. We do have some commercial products, but we don't specialize in commercial. I will help you. And anything financial you want to reach out, I will help you. I have all the contacts in town, but I don't specialize in commercial. As far as residential mortgages go, I would say besides the down payment, Nevada Housing Division, the down payment assistance program, I would say we have every program out there in Nevada.
Excellent. So let's talk about financing builders in particular. Does it mean for the buyer that if they're buying from the builder, they're getting higher interest rate on their loan than if they were buying the resale house?
That's not for me to say what the builder's going to quote them or rate them, but
no, I'm talking about if I come to you with 2 homes at this, with the 2 homes, am I going to get the same interest rate whether the house is a resale or it is a new build, or it's going to be different?
Yeah, the age of the house does not affect the rate. Correct.
Correct. So new construction is going to be financed with the same rate as the resale. So there is no difference.
Correct.
What is the difference? Where you see the difference? Where you see the most frustration of the of the client?
Yes. So I would say something that builders are not going to disclose, and this is something very important for people to know before they go to a builder and ask the right questions, is property taxes. Property taxes with builders are going to be much higher than with a resale home. So you want to be aware of that so you don't come across a surprise after you close. So you want to sort of build that into your budget and ask them what the property taxes are going to be, which are usually 1% of your purchase price. Yeah, that's one. Next, every time you purchase from a company, an entity, doesn't matter whether it's a builder or a bank, let's say it's a foreclosed home or a brand new construction, they do not pay for your transfer tax, your title company. There are several things that they don't get paid for, Leo, and basically by that nature, buying from a builder ends up having higher closing costs. So you want to be aware of those facts, that your property taxes moving on, going forward, are going to be more expensive. Your closing costs are going to be quite a bit more expensive. Now, the builder may pay for them, so that's a non-issue. But if they don't, then you need to be aware of that.
So one more time, what our customers need to be aware of is that at the time of closing, there will be, besides your down payment, there is another lump sum of money that you're bringing in to closing, to the close of escrow when you're actually signing the paperwork and the house actually is being transferred from the seller's name to your name.
Right.
And that thing is called closing costs. And part of those closing costs is going to be either covered by the seller if you're purchasing a resale property, or it's going to be, or you'll have to pay for it if you're a buyer and you're working with the builder, with the new home builder. The new home builder is going to ask you to pay for those.
Correct.
And those costs are not an extra $500. Those costs can go up to 3% of your purchase price. They can be as high as 3% of your purchase price. So this is something.
Sorry, you go on.
You're good. So this is something that is very important because it is a big amount of money that is going to make a big difference to your closing.
You just need to be aware of what your costs are going to be. I get that the home is shiny and it's nice, and you're not going to have any construction costs moving forward because it's a brand new home. But just be aware of your costs. Ask the right questions. Ask the closing costs. Ask for the loan estimate. Understand how much your property taxes are going to be. I can't tell you how many times people have called me 6 months after they've closed on the loan. And Clark County, assesses the property on July 1st. That's when the year starts, fiscal year with our treasurer, and they get the new bill, and then they call me in horror. David, what is this? Just be aware. That's all I'm saying.
And this is the second thing that I wanted people to be aware of, because your taxes are going to be part of your monthly payment. So if we take two homes of the same value of the same purchase price, the monthly payment on the resale is going to be cheaper or smaller than the monthly payment on the new build, just because your new build is going to have higher taxes and your tax payment is a part of your monthly payment.
That's correct.
Am I correct? So you guys are going to feel a couple of $100 difference depending on the size and the purchase price of the house and that annual tax, but you're going to feel this couple of $100 monthly payment difference. Am I correct?
Most of the time, absolutely, yeah. With builders, it's going to be more expensive.
Now, David, you mentioned it. I mentioned it. We're like, be aware of the costs, but can you provide the cost? Can I provide the cost? Or like, why you and I cannot tell the people up front, oh, this is what the costs are going to be?
Well,
like I know we calculate the numbers. We do our best to calculate the numbers up front, but why on day one you and I cannot provide these numbers to people? You tell me from your side, I'll tell you from the realtor side.
We can be as precise as we can, and we're going to be very close in our guesstimates. And which is why when you go into a contract, it's called loan estimate, because we're estimating certain things, and we're, as loan officers, we're bound to that estimate. So there are sections where there's zero tolerance cure, which means if I disclose something to you and the final cost ends up being higher, I have to pay for it as the loan officer. So we're bound to the loan estimate. We're bound to the number that we disclose to our client, which is good. It protects the client. But with the same token, when you go into a contract, there's a lot of things you have no idea. So you don't know to the penny what your closing costs are going to be. There are so many moving parts that come together towards the end of the transaction. Again, we're going to be as safe as possible and tell you what it may be, but we don't know because we're not fortune tellers.
And we usually estimate it on the higher price, but once again, when we're dealing with the resale of the house, just because this process is so familiar to us, and we've done it so many times, escrow done it so many times, those loan estimates, they come in like a day or two, just because it is something that we've done many, many times, and this property is very clear how much those closing costs are going to be.
Mm-hmm.
When we're talking about the new construction, those closing costs, they come from the builder. Those numbers, they have to come from the builder. They have to come from the builder's escrow. So that's why when you're getting a loan estimate for the new home build, it can take them a week or 2 weeks. In like one particular case with David and I, with one file, it took the builder 3 weeks. 3 weeks to deliver the number to us. And so, we did not have anything to say.
In that case, the loan estimate came from us because we're financing the property. The loan estimate gets generated by the bank that we work with. But the costs of escrow fees and all that, yes, and other fees that the builder was going to have, they took their sweet time to disclose to us, but that's correct.
Because do I understand it correctly? You cannot prepare the loan estimate until you get those numbers from the builders.
We can estimate, but if we have to, we're forced to estimate, we're going to show very high numbers, which clients are not going to like because we have no clue.
So you prefer to have those numbers from the builder before you can estimate?
Just to be precise in our numbers, of course. Absolutely.
Excellent. So that's another thing, guys, that we need to pay attention to and that we need to draw your attention to, is that when we work with the new home builders, they are not as quick as the resales. This is not something that you can be like, oh, I want to move in 2 weeks. You know, like the house is ready. Why can I not move in? Why can I not close the loan? It's not going to be a quick can we move it in 2 weeks? Yes, we can, but the builder will probably not. So it is reasonable to expect at least like 30 days, at least 30 to 40 days, correct, to close on a loan with the builder.
I would say it's a safe estimate, yes. If the home is ready. If they have to build a house, then it's going to go out to 6 months, 8 months.
Excellent. Yes, of course. If we're entering at the stage of the construction, yes. If we're talking about the standing inventory, which a lot of people currently like because everybody wants their house quick. So if we're talking about the standing inventory, it is 35 to 40 days.
Right.
If we're talking about we're entering at the phase one, then we'll have to wait for several months until the builder finishes the house, because we can't buy it until the house is 100% built and receive the certificate of occupancy. So now, David, talk to me about the rates and about the waiting time. So if I buy the house, if I go into the contract with the builder today, mm-hmm. and the house will not be ready till September of 2023,
okay.
How does the loan process go for me as the buyer?
Sure. So, all right, you as the buyer, what's going to happen is the builder, if they have dirt, they haven't started construction yet, they haven't broke ground yet, they're going to require an approval from us within 30 days. So we need to issue a pre-approval. We'll submit your paperwork, make sure you're approved, get that approval, and present it to the builder. Now the builder knows that you are able to close a loan. Based on this, they start breaking ground, pour cement, erect the construction and all. Once, let's say it's September, right? So closer to, I would say, August, most of the time, we're gonna start replenishing your paperwork, your income, your assets, all that. So it's a two-step process. In the beginning, we get an approval, and towards the end, we get an approval. We get refresh your documentation, send it for a new approval, and order the appraisal and all that stuff. So that's the process with the builder. Now, since rates are on a very slight increase, what I've been doing, and I've been talking to clients and starting to lock these rates for 60 days, 90 days, 180 days. We have the ability to lock up to 6 months, and sometimes clients do make the decision of locking for a longer period, which is obviously comes with a cost, but they would rather incur that cost now than wait for 6 months and
take the risk.
Take a risk of locking later at a much higher interest rate.
Makes sense. David, we talked about the interest rate. Talk to me about changes in the job. So if we're waiting for the house for 6 or 7 months, it means that my loan application and everything that I put into that loan application, no changes can be made. I mean, no new credit, no new job. Like, talk to me about those things and those changes.
We would ideally want you to not incur any changes, but again, life happens. You may just get fired. You may just get this opportunity that you cannot, like, let go as far as a new position goes. So the only thing I would ask you is talk to me. Talk to me.
Before you make any changes.
Before you make any financial decisions, whether it's financing a car, a necklace, or changing jobs, because and everything comes from experience. Because, for example, if you were doing a conventional loan, you change your job industry, you go from a baker to an attorney, you have to stay in that position for 6 months. So certain things have to happen before a loan closes. So, and this happens constantly. David, I just paid off my necklace. David, I just paid off my car. I'm like, who told you to do that? Anyways, so talk to us. If you're in contract, if we're working together, all you got to do is send me a quick text, call me, or anyone on my team. We'll take a look at your file. We'll tell you. It's not always a no. You can do things, but let us take a look at your file before we sort of give you the green light.
About it,
yeah,
correct?
Of course.
You have to be safe about it.
Always. Yeah.
Another question that we have is the appraisals. Appraisals for the new constructions, can they be waived? How they can be waived, and why the new construction does not really waive the appraisal?
When you use the word can waive and like an appraisal, like in the same sentence, there's so many misconceptions. Understand this: you don't get to waive an appraisal just because you want to, because everybody would waive an appraisal.
It doesn't come from the customers. You're right. I need to correct myself. It's not the customer's right to waive the appraisal. It could be,
It's not even my right.
The property can qualify or not qualify for the appraisal waiver, and that comes from the Fannie Mae, correct?
Fannie Mae's electronic underwriting system. Once we run the electronic underwriting to get your loan approval, which is like the most important document when we start the loan, that document may decide, that system may decide to waive your appraisal. Not always going to happen, but if Fannie Mae feels that you're putting enough down payment, you have good enough credit score, so you're a safe borrower, if Fannie has enough value in its database for your zip code, maybe even on your street, then it's not going to require the appraisal.
So there is a chance that we will get the appraisal waiver by Fannie Mae.
Yes,
not
Fannie, Freddie, always a chance, and we do look for it. We try to kind of push the system to issue the appraisal waiver, but I wouldn't hope for that. That's not something you call your loan officer and be like, you know what, I'd like you to waive my appraisal. That's not how it works.
Excellent. And so something that actually your team and I were discussing on the new home builders, and something that I was told by Andre, who actually did the research on it. So there is absolutely no data on the brand new homes. So there is no way for us to waive the appraisal just because the data on that home does not exist. So
Fannie does keep in its database streets, maps, and home values. If this is a new construction, new neighborhood, then obviously there haven't been enough transactions where it would feel comfortable enough, or the neighborhood isn't established enough where it would be comfortable enough on the value for you to waive the appraisal. That's not impossible. We just haven't come across it. So,
excellent. So, another question: when we're going through the loan, when do I bring the money? When do I bring my down payment? When do I bring my closing costs? At which point of transaction do I bring the money?
Yes.
And how much?
Great.
And how much?
Well,
the main question is how much?
Or we'll tell you how much. So, okay, you're going to show us the money before we issue the pre-approval letter. One of the things, going back to the CIA assets, we're going to ask for your bank statements. We're going to look at it, make sure it's clean and submittable. I just made a word, submittable to the bank. If I see something dirty in there, we're not going to send it to the bank. I'm going to have you wait, season, whatever. So we'll work with you. Let's say you go into contract, your assets are clean. The number one expenditure you're going to have is going to be your down payment, the deposit, earnest money deposit.
Yeah, the deposit.
5,000, 7,000, whatever that amount is, you send that from your checking account, right? From the account that you have shown us and we have cleared. Do not surprise us. Do not send it from someone else's account, an account that you haven't shown us. It needs to come from the account that you have shown us. Now, the money, to answer your question, comes in later, toward about a day or 2 or 3 before we close the transaction. A closing disclosure comes out. We know exactly how much your closing costs are going to be, your down payment going to be, and once we have that number, my team calls you, escrow calls you, and you go to your bank and make that wire.
So pretty much 3 to 5 days before the close of escrow, before the final date, before the buyer is going to sign, they're getting this closing disclosure, and they're also getting something from us, from the agents and the escrow, which is called the settlement statement, which the two numbers are going to be the same, guys. You will never see, like, if you see two numbers and they're different, then there's something going on in your file. That should not be this way. You're going to see the closing statement estimated settlement statement, closing disclosure from the lender, and estimated settlement statement from escrow. These are the two documents that are actually going to have the same fees disclosed in two different forms and shapes. But the number at the bottom, this is the number that you are going to bring or wire into the escrow to purchase the property. Those numbers are going to be the same. Part of that number is going to be already in escrow. That is your deposit that you actually submitted at the very beginning when we just came into the contract. There could be some more contributions from the seller and from other sides that could be also accounted for, but that number is going to be disclosed to you 3 to 5 days before you purchase the property or sign the documents. That's one. And then a day before you sign the documents, that money should be already in escrow, coming from the account that you disclosed to the lender, nowhere else.
No surprises, please.
Yes, no surprises. So this is when the money is due. Next question is, okay, I purchased the house. What is it today? March 16th, I purchased the house. I signed the documents today. We recorded. When is my next payment, David?
Yes.
When do I make my first mortgage payment?
At the end of the following month. So, May 1st. Or
May 1st.
May 1st. It's easier to put into a sentence when I say at the end of the following month. Yes. So, you're going to make your payment at the end of April.
Let's explain it to the audience. Why is it so? Like, why, when we're making rent, in a simple, not complicated way. So when we're paying rate, when we're paying like rental, when we're making rental payment, the principle is we first pay the landlord for a month, and then we get to live in a house for a month.
That's correct.
When we make the mortgage payment, the process is actually reversed, correct? We first live for a month in a house, and then we make a payment at the end of the month.
That's correct, because that's how interest works. Interest accrues at the end. And since you have a mortgage, you have a balance, you have an outstanding balance which you need to pay for, that balance accrues after the period is over. So you're going to make your April payment at the end of April, in the beginning of May. So on May 1st, you're going to be paying 4 Aprils. duration that you lived in the house. As far as this month is concerned, it doesn't matter which day in March you close, whether it's the 3rd, 16th, or the 21st. The remainder from the closing date till the end of the March 31st, however many days are, you pay that per diem, per day cost in your closing costs. So your closing in the month, the interest cost for that month is included in your closing costs, and the interest for the following month you pay at the end of following month. That's why you sort of get a month and a half of no mortgage payment. It's not so. And it looks like it.
And I think that was a great explanation. So I know it's not an easy one, but it was a great explanation. But there is one more thing that I need you to talk about, and this is something that our customers usually see in their closing package from the lender. And this is that flip when they're getting told, oh, if your payment coupon is not going to come in, this is where you're going to make a payment. And then the customers get a call or they get a notice in the mail saying your loan has been sold. And I've had so many, I had so many scared calls because of that. Can you please explain the process, that it is something normal and this is something that we can actually, how to handle it correctly?
So a lot of times clients come in, David, I want to refinance because my bank sold my loan. I know you're good, you'll take care of me. Make sure you refinance me to a bank that will not sell my loan. I'm like, that is not a reason to refinance. I have no guarantee any bank will not sell your loan. It is a tradition. A lot of times what happens is once the loan is originated, it's closed, it's an active loan, it goes to a servicer. A lot of times when we originate the loan with a bank, that bank may not service loans. Not every mortgage lender services loans. So they transfer it to a servicer who's going to send you bills, who's going to make your tax payments and all. A lot of times these servicers will bulk up these loans into a nice little package and will sell it to someone else. So that does happen. It's not our decision, not mine, not the client's. This is going to happen. And there's a document that you sign in your closing disclosure and closing package. It really, really doesn't matter, because at the end of the day, these are all Fannie Mae loans. These are FHA loans. These are still insured by the government. So it's the bank that it gets transferred to really is just servicing your loan. Is an 800 number to answer your questions, to make your tax payments to the county, to send you bills. That's all they're doing. And they're making a very, very, very small percentage of that. But that's it, really.
And that's already built into your loan. First of all, you're not paying anything extra for that.
You're not paying anything
correct
extra.
And the fact that your loan got sold to another bank, it does not change anything for you as far as your principal balance is still the same as it was with the, as it was. So your monthly payment is still the same. It does not change. And of course, your interest rate does not change until you refinance. So whether you were paying to Bank A and now you're making your payments to Bank B, and maybe Services C is actually servicing your loan, for you, it doesn't really matter. You're making the same amount of payment for the same property with the same interest, and your principal balance is being transferred, and it's going to deplete with every single payment, monthly payment that you make.
It gets frustrating sometimes when you have to establish a new account, new online portal, make that first payment. Once you make that first payment, everything else is easy from that point on. But I do know that my wife is frustrated just about every first of each month because one of the mortgages gets transferred, and she made the payment to the old company. The old company has closed our account. So when she calls from the bank, from her phone number, the automatic system basically says your loan's closed. It's not an active loan, and it hangs up on her. And I just, it's frustrating. She has to call the new bank and have them transfer the payment that went there because it's on auto pay to the new bank. It can get frustrating. We understand. we actually have a preferred lender, United Wholesale, who's the biggest lender in the country, and UWM actually does service their own loans, most of them. So UWM does not sell servicing like others do, and I think we haven't had.
But they sell the loans. I used to be serviced with them, and they still sold my loans.
They will. That's not a guarantee, but recently UWM has been very active with offering low interest rates, and the way they want to sort of make it up is by servicing, and they're going to make a little bit of money on servicing part. So this is how they're being competitive against other banks, which works for us as consumers and clients. So we have been placing a lot of our loans with UWM, first of all because the rates are lower, but also with the added benefit of they usually don't sell their loans, which is very, very convenient.
Excellent. So there's nothing to be afraid of. The only thing that I would ask people to pay attention to, first of all, check your mail, because you will be notified in a mail, like in an envelope, that your loan got sold. If you have any questions, call David, call your loan originator, call them and ask them, hey guys, can you please verify that this is my new loan number, that it got transferred, and that I'm going to make payments to the right thing? Or when do you make the payments? Also, those letters, when your loan gets transferred or gets sold, that letter will indicate actually when you start making your payments to the new loan servicer or to the new bank. Correct. So that's something to pay attention to. And
just talk to us.
Absolutely. And the last question that I probably got like 6 or 7 calls this week on, with the Silicon Bank, with the, First Silicon Bank going bankrupt. I got a bunch of calls this week asking me, so now that some of the banks are going bankrupt, like, what if I have a loan with the bank X and then bank X goes bankrupt? What happens to my loan?
So there's a lot of fear out there.
Like, are they going to come and take away my house?
No, because again, if you have conventional FHA, VA loan, these are insured by the government, and they're not going to go away. Again, the owner of your mortgage, technically, at the end of the day, is going to be the government, and all these little banks are just servicers. I don't know if Silicon Valley Bank did service loans. I'm sure they issued mortgages. I don't know if they serviced. So it really, really doesn't matter.
Well, they
lost
specializing in lending capital to the tech companies.
Yes. So what they did is
financing tech companies
lent the capital, and they actually made bad investments with the bond. There's really, really good material online, which even on the news. I'm not going to do it justice to even dive into that. It's not my expertise. But people are drawing parallels to 2008 in here, and you shouldn't. This is not a Lehman Brothers situation. It is not. It's just rates are high, and that's going to affect some people. Some of their executives made bad decisions. They invested in treasuries and whatever. You can see the mechanism of how it all spiraled into this. That bank did not disappear. It just filed for bankruptcy. It's going to get restructured. It's going to have new executives, new management, and we actually did have a client that filled out an application with us, and we on Saturday, I think I spoke with him last Saturday, and on Monday our team comes in. We start collecting documents, which one of the documents would be his bank statements. He's like, guys, I don't have any money, sorry. So give me a month till the FDIC makes me whole because his deposits got lost. FDIC has to pay him back. Yeah, so he's waiting to be basically his money's still insured, so he's not concerned. He was making a joke out of it.
He just can't reach and grab it.
He just cannot reach and grab it. He cannot download his statements and send them to us. So we're waiting for him to for FDIC. I don't know how this process works. I've never seen this before. So FDIC is going to have to pay him, and then at that point he will start applying with us again.
And once again, bank going bankrupt, a certain bank going bankrupt, even if they hold your loan, Even if they're servicing your loan.
You're okay.
It does not, you're okay. You're still going to have your mortgage. Nothing is going to change for you. You will probably get something in the mail saying that somebody bailed out that bank and now you're making a payment into a new bank.
This is United States, guys. You're safe. Your money, your deposits
You're
are
insured.
safe. You're insured. As long as you keep your deposits spread out, if they're more than $250,000 in different banks, different accounts, your mortgage is insured by the government. You're okay. Yeah.
Thank you, David. Thank you so much. Once again, thank you for answering all of our questions. It was very informative. Now we know that we can easily finance any new construction
homes
with you.
Construction.
Yes. Whether it's a construction, whether it's resale. Hi, Mike. Good to see you. We got Mike from Arizona. One of my referral partners in Arizona from the Tom Ferry. Mike is with us. Thank you for joining. But we're wrapping up. Mike, if you have any questions to our lender, and David is licensed in Arizona, correct, David?
Yes.
So if you have any questions, Mike, go ahead. Throw them in. If not, we will answer them next time. And thank you so much, David. Thank you for your time.
Pleasure.
Thank you for your input. And thank you for your brilliant team that actually makes our clients happy every single week.
Oh, my God. Thank you. Thank you very much. Enjoy the vacation. Send photos.
Thank you. Thank you, guys. Have a wonderful week. And keep on shopping.